Yo, yo, yo! What is up, guys? Happy Friday, October 17th. Favorite number 17, favorite day of the week, Friday. It's going to be a good one. Back with another episode of All Gas, No Breaks. Was going to originally go into a different topic this week, run All Gas, No Breaks once a month, as it's one of the favorite shows I do. It's one of your guys' favorite shows. But with the market looking like it looks, I figured we'd crank out another 20 charts. Another 20 charts, kind of give you my view on the market as we go. Kind of starting a little bit big picture, talk about some intermarket analysis, talk about volatility, and maybe the bottom. The bottom for some of the pullbacks is here. Maybe that's the case. We shall see in the chart. So you guys know the drill. 20 charts in 20 minutes. So we will go ahead and get started with the first chart. Let's get into it. So starting here with the S&P 500, okay, you got to zoom out. I think a lot of times we can get stuck up in the minutia of the daily details, the daily news, the daily this, the daily that, and forget to zoom out and focus on the compounding effect that the market has. So this is a chart we like to look at most weeks. S&P 500 in this middle panel, these are weekly candles, right? We have momentum using RSI in the top, and we have members above there, 200-day in the bottom panel. Thing I want to highlight here is that we're in that sustained uptrend period. Last week we kind of got whacked, but inside week this week. So nothing crazy happened. The downside didn't follow through. The bulls didn't land another punch. The bears got back on their feet. So with that in mind, a lot of the charts are going to kind of show that messiness from the top. But overall, this is a sustained uptrend. The one difference we have from the recovery back in 2020, October bottom, is the fact that the percent above the 200-day is not above 70, which I would like to see, but the market doesn't care about what I would like to see. Next chart I want to get into, talking a little bit about that breadth. Piggybacking on the breadth is S&P 500 daily candles. And then in this bottom panel, we're looking at the S&P percent above their 20-day moving average. Sometimes what can happen is breadth gets so bad that it's good, right? So really weak breadth that is getting less weak is typically a buy signal, right? That's like a buy on dip signal in terms of the S&P 500. Partnered here with the 50-day simple moving average, you can see you have a pretty clean risk reward when we get to these capitulatory levels, you could call it, just washout levels in breadth. So I kind of like this setup here. So what do I want to see? I want to see some follow through to the upside in something like this. I get more into this in some newsletters that I've written, kind of some of my research notes. But in general, I think above this 50-day with breadth improving, you have to be a little bit more optimistic than what some of the price charts are showing. Speaking of optimistic, an area of the market, we'll start with an area of the market that I think looks pretty good, healthcare. I think healthcare is completing this reversal. And you can see here, right, this is one of the larger components of the S&P 500, healthcare. And you can see here, we're kind of just consolidating sideways. Look at that RSI is above 60. And you can see this big candle today making up for all of yesterday's move. And I like the looks of healthcare kind of rebounding here. I think it looks good overall. I think it's a way to diversify from some of the tech-heavy areas of the market. Last week, right, everything kind of got hit, but this one is kind of still staying above trend. So look at some of those healthcare names. One of the areas in particular that I like in healthcare, pharmaceuticals, IHE. And what we see here is a beautiful breakout retest, classic breakout retest, right, with strong RSI above 50. And you have really clean risk reward against this 7250 level. So some areas of the market look a little messy, which we'll get into. But pharmaceuticals overall, IHE, believe it's Eli Lilly, Johnson & Johnson might be the other biggest component in this name, but I think it looks solid. This bottom panel I'm comparing to RSP. The reason I'm looking at RSP is because I want to look at the average stock in the S&P 500. I don't want to look at the cap-weighted S&P because sometimes when you're looking to diversify, you're trying to get away from tech. So underperforming tech might be a feature of that because I don't want to look at that concentration. So we can kind of look at the average stock here. Pharmaceuticals don't look bad. Next, I want to talk about the big topic from this week was related to financials and some of the credit burden related to financials. Just quickly, because I got a minute, I want to talk about charts and not just pontificates. Right. Credit, if there's risk of credit, it doesn't matter if they're gaining more on their loans because the loan book itself might not be as valuable. So that's kind of the positioning of that. Right. Rates going lower is all else equal, ceteris paribus, bullish for financials because it can collect more net interest margin as the slope of the curve kind of steepens. What I like here is even though it looks like a breakdown, we're really close to that 200-day moving average. We're really close to some potential support here. You can drop an AVWAP from the April low, also drop an AVWAP from the pivot high. A lot of support coming along the way for financials. I think what we want to see in financials is what American Express did, right? This is why it's hard to go really bearish in a bull market. See what American Express did? Failed breakout, failed breakdown, nice follow through, this whipsaw pattern. If we start to see these are features of a bull market, right? You start to see more and more of these patterns in bull markets where breakdowns fail. And that's what we want to see. We want to see breakdowns fail. And this is what we'll want to see in a lot of charts because a lot of charts are actually looking like American Express 2-3 days ago where they're below. But we want to see that hook higher and see that follow through. American Express names, I think it looks solid here, right? Solid outperformance, especially relative to the financials, but that's what we're looking for. See, look, consumer discretionary, right? When you look at enough charts, you start to see that trend. Consumer discretionary is below that level. What do we want to see? We want to see the same thing. We want to see this whipsaw back above it. The one thing I would note here, looking at RSI here, and you'll see this in a lot of these charts, is that consumer discretionary, the RSI stayed above 50 for a long period of time. Quick little panic here. Now RSI is below 50 and it kind of got rejected yesterday below 50. So below this level, I see no reason to be overly bullish. I don't see a reason to be adding, but this is the caveat. This is why I think it's just a time to be patient with a lot of these charts. We only have like 2 to 4% lower before we get into some real potential support where I would actually probably be a buyer. So it's just this no man's land. It's really a range that might capitulate to the downside or resolve higher, but you kind of got to wait for that move in something like consumer discretionary. Next chart I want to talk about messy ranges. Look at industrials, right? Industrials are in a messy range, right? It's consolidating via time, right? And that's what tends to happen a lot in markets that are, robust and bullish is you see consolidations take place sideways. And this has really been consolidating since July. We've just had this consolidation in industrial. So it's an area of the market I'm watching. I'd love to see this resolve higher, stop with these fake outs. It's great to see it not breaking down from last week. The bears really didn't get any of that downside follow through except for regional banks, really. And so that's great to see for the market because the punch landed, but we got back on our feet. So now we're going to see what we can do this upcoming week. But industrial is another area of the market that I'm watching. And kind of the exception to this kind of consolidation or breakdown where RSI gets below 50 is technology and utilities, right? Technology, 33% of the S&P 500. Because guess what? If it's the exception, it matters, right? Because it's 33% of the S&P 500. So if something can be an exception to the market, it's tech, right? That's why you can see weakening breadth. You can see these other things because tech is such a large component. I put out a video called the Achilles heel of the S&P 500 a couple weeks ago. It's tech, right? But tech is on the field scoring points, right? RSI kind of tried to break down and it's stuck, staying above 50. It's been above 50 since the April lows. If tech RSI is above 50 and we're still sloping upwards, it's hard to be bearish the market indexes because it's just a third of it, right? So just pay attention to that. It's easy to try to think 24, 25 steps ahead when the market's messy. There's no need to. Just take the price action as it is. Zoom out on some of the charts. Look at the characteristic of price and momentum in tandem and understand that context. Next chart, another exception, utilities, right? You can kind of look at tech as, right, utilities fueling the tech AI boom, the data center boom, blah, blah, blah. Point of this is charts, not at the moment, is something like Meta. I think if you run a lot of charts, like I mentioned, you can look at financials, industrials, you can look at consumer services. You run a VWAP from prior highs, you run a VWAP from April low, you put on a 200-day, you see a ton of support in a lot of the charts right below where they are. So it's easy to look at a pattern like this and be like, man, it's bear flagging and it's going to break down. Well, sure, but it might break into support. And that could be the capitulation that then gets that market to kind of resolve higher. So I don't see a ton of great shorting opportunities at inside the S&P 500 from this perspective, right? I see a lot of this choppiness sideways in the names that right help move the market. And so if Meta's kind of in this no man's land, let it be. Wait for resolution in something like Meta, and it's a name you got to watch because it's roughly $2 trillion company. Next thing I want to talk about is VIX futures, and in terms of the VIX curve, the curve of kind of short term. So top panel is short term VIX, bottom panel is midterm VIX, and then it's short term over long term. Think of it this way: if someone is willing to pay more for risk protection shorter term than longer term, they're probably overpricing the risk in the current period. So what you see is you see these spikes, you see panic spikes, type of panic spikes. And typically they're capitulatory. They're when people are pricing in too much risk in the present versus the future, which if you understand one, time value of money or time value of risk, typically the longer you go out, the more it costs you for risk. Right, so longer dated options cost you more than shorter term dated options because there's more array of possibilities for it to expand. So looking at the VIX, you can kind of see this spike. You can see, okay, there's some, based on some of these charts, there might be some irrational premium priced on risk. And then you couple that with S&P 500 one-day rate of change. So if VIX is above, I'll get to this VIX chart in a minute, but if the VIX is above 20, right? So it's pricing a move greater than 1% every day, and the one-day rate of change is staying below 1% a day. It tells you that there's risk that people are concerned about that the S&P 500 isn't expressing. So people are pricing in bigger than 1% moves, but we're actually just consolidating sideways. And so that leads me to believe that's bullish for the market because people are probably a little too risk averse at the moment. They're taking on too much volatility exposure at the moment. And then I might not have put it in. And then the next chart I just wanted to talk through was look at the S&P 500, flip it upside down sometimes, right? This is an inverted chart of the S&P 500. In stock charts, you just put a negative symbol and SPY. And what I want to show you is just the counter trend nature of the move that last week was. So you set the 50-day and 200-day. This looks like a strong downtrend to me. Right, and it looks like the upside of this, the downside of the S&P 500, is not favorable. Right, it's guilty until proven innocent. Right, if you're below the 50-day and below the 200-day, you're guilty until proven innocent. So you need to see that follow through before you go pontificating the debt crisis or what Trump's doing or the Fed government being shut down. You got to realize everyone worried about that present risk is pricing it into the market. So then you got to ask yourself, what can go right if everyone is focused on what can go wrong? Think about that. When risk premium is elevated, right? People are paying more for protection against risk in the present. The question you shouldn't be asking is what can go wrong? The question you should be asking is what can go right? So think about that this weekend. What can go right? Let's look at another chart here. S&P 500 retail, right? So this is 90 equally weighted retail stocks. You kind of see this downtrend. You kind of see below the support level. So you can see why some charts don't look great and why you could worry. But a lot of times, right, we've recovered from the lows. So we need to break out from here, get that RSI back above 50. But this is just something I'm watching from like a risk gauge, risk sentiment standpoint. I want to see this kind of curl back up because if we continue this down channel, we probably see that continuing consumer discretionary. We see that resolution lower. But right now we're just in that no man's land where we kind of broke down last week. The fighters got back on his feet. The bears haven't thrown another punch. The bulls haven't thrown a punch. They're both just standing there with their gloves up. And one of the reasons, right, you can't really be that bearish is Mag 7, right? The leadership, the MVPs, right? They're just consolidating. This is consolidation, just consolidating, right? RSI is still in this bullish regime. This is 33% of the S&P 500. So it doesn't matter what Breath's doing with the concentration we have. It does, but it doesn't at the same time, because if the Mag 7 are on the field, man, it's hard for the market to go down. It's hard for the market to break down when Mag 7 are just consolidating sideways. Just want to go over a couple setups here. Looking at something like Reddit, kind of if you look at leadership, you can look at leadership a lot of times when markets kind of get messy and just see we have this failed breakout. And that's what we were seeing a lot in the market. It's just these failed breakouts in some leadership names, some names that were breaking out and succeeding. And we saw some increased volatility. But a lot of times these stocks will kind of trend sideways, consolidate sideways, maybe before leg higher or leg lower. But something like Reddit, if you're looking to get short, it's below 200 against this level. Or if you're looking to get long, we might see a whipsaw back above 200. So you're kind of at this point where you have really well-defined levels, and we're just waiting for that move, whether it's higher or lower. And I think that will be the real move. And then you see follow through in that move. So something like Reddit is just an example of that. That meta chart, another example of that. What happened with American Express is what we want to see as bulls, but not necessarily guaranteed it. Apple, right? Another example of a strong stock, bullish setup here, failed to break out, but we're kind of just doing this like little cup and handle consolidation here. RSI staying above 50. Right? One of the largest stocks in the world. And this is an area of the market you want to watch, because if this breaks out, it doesn't matter if the 50, 60, 70, 80 stocks that are the bottom quartile of weight in S&P 500 are breaking down, because if Apple's breaking out, it's such a large component, they can carry the ship. Tech and Mag 7 can carry the ship. All right, so let's get something stinky. Some stinky trades, some stinky stuff is looking at home construction and home builders, right? So if we take a step back and we look at the longer term trend, okay, the market is in a bull market, right? The context of the market being in a bull market is big because we know a lot of times breakdowns fail. We know that key levels tend to turn into support. We know October is a volatile time of the year. We also know October is when the market tends to bottom. And we're celebrating 3 years of this bull market in October. And what do we also know? The Fed's in a cutting cycle. So if we look at something like Homebuilders, kind of rallied. We actually talked about this trade a lot. Rallied, and then we kind of saw a sell-off, but back to the 200-day. RSI didn't really get oversold. This is a logical level to bottom fish, right? Bottom fish against the 200-day, using that as your stop, $100. Maybe nibble here. And if we start to dig in, right, this resolution could tell us a lot about the market, because home builders and home construction is a real worry of the market, especially if growth slows. But if we have those yields lowered, that's essentially what the Fed's trying to do, right, is re-stimulate the economy. What's a big part of the economy? Housing. So what are they trying to stimulate? Housing and the labor market, right? A lot of labor is associated with housing. So I actually like this setup. It's pretty stinky, but if you're looking for something to bottom fish, I think you can look at these names and kind of draw those levels to manage risk against. Next chart, we've talked about it, but I still like Treasury here. I still like yields. I still like having exposure to bonds. I think this base is just something to eye. I think you continue to see the strength in the RSI. You continue to see this bottoming. You continue to see a president that wants rates lower. So I'm not going to fight him. I'm not going to fight the trend. I'm not going to fight the Fed. I'm not going to fight the president. So with that, guys, that's my charts this week. That was 20 charts, little over 20 minutes. Just an FYI, I won't be around next week. I'm headed to Manchester, headed to the UK tomorrow. So if you guys have recommendations in the UK, let me know. I'll be there about a week. Yeah, should be a blast. But if you guys want to subscribe to some of my work, you can check it out here. Saturday, I write a blog. Sunday, I do the Sunday stock list. That's my favorite list. Kind of starts I'm looking at that week. Tuesday, Thursday, I write Thompson 2 cents, just a quick hit note. And then I go live on Fridays. So guys, let me know in the comments some charts that you guys are looking at. Which way do you think this is going to resolve? Do you think that that stinky home builders trade is a solid trade to take on? Give this video a like, give it a comment. That really does help. Feedback also. Like, let me know what you guys want me to include more of, less of. That stuff is helpful. But either way, I do genuinely appreciate the support. I think the market's a little messy right now. So just wait for some of those resolutions, right? Or have those key levels that you're managing risk against to probably break higher. But it is a bull market. Take a deep breath and enjoy the weekend. Cheers, guys.